Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Sorry about the delay there. The little technical difficulties. This is Bill Bullington here every Saturday morning, 11 to noon. I'm in the studio live today, so if you'd like to call in and ask a question, it's 216-901-0945, 216-901-0945. And, boy, we've been having an awful lot of volatility lately. That's actually to be expected. I'm kind of surprised that it didn't happen sooner and that it's not actually a little bit deeper. But it's one of the reasons that I'm constantly trying to remind everybody on my show, the newsletters that I send out. And there was a really good newsletter that came out this past week. There were several articles in it that I really liked. And I don't write them. I edit the newsletter, and then I send it out to anybody that's listened to this show, gone to the website, and said, hey, I'd like to get a copy of that newsletter. And there were some very helpful articles this week, I felt. So anyway, maybe after the next commercial break, I'll actually try to see if I can find it on my laptop and go over some of it, because there was some really good stuff there. I was really impressed at the selection of articles. They give me a selection of articles. I get to pick which ones I want to go out. And so anyway, there's just an awful lot going on. It's amazing. When I'm always saying this. If you've heard my show for any length of time, it's different this time, and it's always different this time. And normally, when people are saying that, it's not actually, I take that back. In the late 90s, it was a positive thing for them. They felt as though the stock market was going to go forever. And that was the excuse, or not an excuse, but the reasoning was, this is different. The economy is growing faster than it has. Technology is growing faster than it ever has. And actually, technology stocks in the late 90s set records for large amounts of growth over short time periods. And what people thought was that this was going to last forever. And that's why it was so surprising when the market started going down. At first, people didn't want to believe it, and then it kept going down. And technology stocks were selling at prices they probably shouldn't have sold for another 10 years if they had continued growing at the same rate of growth that they had in the late 90s, which was really fast. And sooner or later, that ends. What's different about that time and this time is that, there are lots of companies that are growing and doing fairly well. Valuations aren't nearly as high, so people aren't paying nearly as much for stocks as they were back then. And that's a good thing. And is the economy going to slow down? It's already slowed down. It's going to slow down a little bit more, and then that's just normal. This is all normal stuff. The fluctuation, it's normal. It's just normal fluctuation. The reason I think most people today think that it's higher than it has been in the past is that you weren't able to track it nearly as well. You didn't see it. People weren't logging into their 401k plans, every week or every day. I know some people will log into their plan more than once a day, and I don't know if they realize that those, unless there are ETFs in their 401k, which is not not very popular. I'd say probably less than 15% of 401ks have ETFs in them. So if you don't have ETFs, you don't know what the value of the fund is anyway. So logging in more than once a day is probably not helpful because you're only getting pricing once a day, and that pricing comes after the market closes. So I think it's kind of funny. But anyway, if you have a regular brokerage account, you can log into it and you can watch it, tick by tick. Not recommended. I promise you, not recommended. What helps during times like these is if you go back, talk to your financial advisor and review what has gone on in the past. Review why you're doing what you're doing. Why am I carrying a broad list of these exchange-traded funds or individual stocks? It's because diversification helps like a lot. And how have they done in the past? What kind of key attributes do these funds have that would cause me to want to include them in my portfolio? And, just basically investing 101, just review. One example might be there's a mid-cap growth fund I like a lot. It looks at companies that are determined to be medium size. And by the way, that's done by Russell, not me. So the medium-sized companies, why do I have them? Because they have a tendency to grow faster. And then they throw on a criteria that says these things need to be in the top X percent for profitability. So we want the most profitable companies. So that's good. That eliminates a lot of them. And then they add another feature. We also want these stocks to be performing the best right now. That's called capitalization. That's what that does. They look at the market capitalization, and those that are the largest get in. If a company's stock goes up, its market capitalization goes up, and it may get included. So you take those criteria, put it together, and it's a very powerful list of stocks to have in your portfolio, and it makes you feel better when you know the theory behind what's going on and what's in your accounts. And I've got this tool that allows me to take up portfolios and look at the overlap between funds. A lot of people have a lot of overlap, and that's not necessarily that bad because the funds themselves are pretty widely distributed amongst stocks, or in other words, they have very broad diversification. So if two funds or even three funds are holding the same stocks, they're probably not holding a ton of them in any one of them. So that you don't have to worry too much about it. It's a little aggravating if they're in taxable accounts because you get a 1099 and it's got a lot more transactions than you actually need to have. And so that is just one of the things I see happening a lot these days. People come in and they'll have a ton of different funds, and you look at them and go, okay, that stock is in 5 of your funds, and this stock is in 7 of your funds, and it's okay. As long as one of them is not more than 4 or 5% or so of the total when you add it up, you're doing pretty good. That's actually very good. So if you care to call and let me know what you're holding, I can actually load that up for you and take a look at it and tell you how much overlap there is. But by and large, it's really interesting today. If you've got a halfway decent strategy over long time periods, like I said, it has a tendency to do really well. The economy, despite what the raising of the interest rates, is still hanging in there. I'm amazed at how resilient that is. And I know a lot of people are upset when they hear me talk that way because they're thinking that, well, if the economy is doing so well, why doesn't the stock market respond and go up? Why is it going down? Well, because they're stocks. And I know I've said that my entire career, and when I was younger, I thought it was funny. But now it's just logic. If you looked at stock price movements and increases in sales and profits, which generally are the drivers of stocks over the long run, you're going to notice but they don't move in lockstep. The fancy word for that is correlation. The correlation is very low. When one is moving in one direction, the other one's not necessarily moving in that same direction. In fact, most of the time they're not. For a large portion of the time, they're not. Now, eventually, and if you go out and you look over a long enough time period, those things coincide pretty well. But over a 2 or 3 year time period, you can have really broad variances, or the stocks will stray away from what the underlying numbers are saying. Both directions. People get overly excited. Investors invest more heavily in stocks when they're going up. They get overly upset. They start pulling money out when stocks are going down. And here's the secret to that, by the way. I figured this out a long time ago. The risk tolerance questionnaires that you get, this is the key question. There are lots of questions in the questionnaires, but the key question is, how much of a decline do you really think you could withstand and not panic and want to go to cash? Now, you have to think about that. And I'm telling you, I get calls all the time when the market's down more than 20%. I'm getting calls saying, yeah, but, and I'm like, well, okay. You just put that in writing, write it down, send it to me, or email it, or whatever. We can reduce exposure, but I wouldn't recommend that you do that. I promise you, things are going to improve, at least financially. It's the nature of the beast. About a little over 100 years ago, there was another pandemic, and then we went into a world war. And you know what? Markets recovered. Now, you have to be careful when you get past the age of 60, because you may not have 20 years to if a really bad market comes out, like the one during the Great Depression, it could take a couple of decades to recover. That's one of the reasons you just have to be really careful. Keep a large portion of your money in short-term bonds, and you've got basically it creates a reserve so that you can put money into stocks when they are down. If you've got that, you have the courage to do that sort of thing. And think about this: if you were a 50-50, let's say you had 50% of your money in fixed income, 50% of your money in stocks, and the market goes down 50%, you get one of those big doozies, one of those ones that doesn't show up that often, thank goodness, but occasionally it shows up. Okay, so you would only be down 25% of your total. See how easy that is? This is the main question on my questionnaire. Figure out how much of a decline you could actually take. And 25%, I'm actually at 40. So I've got a fairly significant portion of my money in stocks and in stock funds. And if I'm down 40%, right now I'm not happy about what's going on. I mean, it does make me kick my heels on the way into work, but that's okay. I understand that that's how it works. I don't plan on retiring anytime real soon. Actually, I'm going to try to go as long as is humanly possible. I like what I do. So, and I'm used to it. And do I look forward to the market going down? And not necessarily. However, okay, I do take great pleasure in the fact that every single month I shovel money into my retirement plan. And so right now, those dollars that I'm putting in there, they're buying a whole lot more shares than they would have bought 6 months ago. And think about that. So if your goal is to accumulate and you're still working, or even if you're semi-retired, that rebalancing act, if you've got 50% of the money in bonds, or had 50% of the money, well, now it's probably closer to 60%. So you might take 5% of the money, buy stocks. It'll make you feel better. You'll be getting more shares than you had before you made the purchase, and you're getting them at lower prices. And that makes a big difference. In the long run, that makes an enormous amount of difference. And so those are the things that are a couple of the things that I like to try to concentrate on every time I buy stocks.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning, 11 to noon. You can reach me by going to my website. It's bullingtoncapital.com. And there's a contact us form there. If you fill that out, I'll call you back or email you back. Now, there's actually still music playing in the background. So yeah, reach out to us. I'll be glad to see if I can answer any questions for you. You know, people are incredibly upset today, and you know, it's interesting to me though. I don't really understand. I mean, I guess I do, but I've seen this so many times, and it's just another correction. This is going to go away. The economy is growing, and there are certain sectors that are growing. We're going to have incredibly low unemployment for an extremely long time period, especially when we get through these couple of issues that we're dealing with right now. And when those go away, we will absolutely be in tip-top shape, and we're actually in pretty good shape, despite the fact that we've got there are some major things that are happening right now. And again, I'm still kind of surprised. I'm just surprised that things aren't down more than they are. It just blows my mind to have everything that's going on and to be down just a little over 20%. I know a lot of people going, 20%? Are you crazy? That's a lot. And it is. It's a lot. Okay. But it's not 50. And if the market were to reach the levels that it was at in just a little over a year ago, then you would have a gigantic correction. But I'll quit talking about that right now, because you know what? The bottom line is you don't really know. What you do know is stocks over the long run have a tendency to do better than most other investments. What we do know is that interest rates are rising, so now you can actually get a little bit more yield. Any short-term bond fund, you want to look at the average maturity of the bonds in the fund, by the way. And that, I know that information is probably hard for you to look up, but if you have that questions with one of the portfolios that I'm managing for you, just give me a buzz, because I know you don't probably sit around looking that stuff up. So the duration is a number that a lot of professional portfolio managers like to use. I'd prefer average maturity. What's the average maturity of the bonds? I think it's a little simpler. I think people can understand it. And if your average maturity is more than 3 years, I probably would look for a different bond fund. If your average maturity is not down around 18 months or less, then I would probably just switch it out. Because if it is longer than that, there's a really good chance that it's probably down, and then you can do some tax loss harvesting. So I've got to take a real quick phone call now. If you'd like to call in, the number is 216-991-0945, and I don't know who it is, but you're on the Bullington Capital Report.
Hi, Bill. It's Joe.
Hey,
Can
Joe.
you hear me?
Yeah, I can hear you now.
All right. Well, I've been listening to you, and I've known you for a long, long time, and I'm an advocate of everything that you say.
Thank you.
Something surprising I heard today, though. I can tell the screener of this, but you're saying, about having a multiple different maybe mutual funds that has same stocks in it. That's what I've always worried about. But that's not what I called about.
Right.
Is there a way to look up these different recessions that we've had to see when they started and when they bottomed out and how long it took to get back to their normal state again?
Yeah, you can go to the Bureau of Labor Statistics online, and you can look
labor statistics. Okay.
Yeah. Yep. And
Okay.
and the Fed's got a lot of information on their websites. It's been a long time since I've been on that one, but they used to have a lot of information on that as well. But yeah, you can take a look at that. And by the way, what's really interesting is if you look at the economy and how the economy is doing, and then you were to overlay the stock market on top of the economy, you're going to see that they don't match up. So, because that's one. Actually, the Fed went back. This is back, in ancient history. When I was in school, my economics professors told us that the Fed used to look to the stock market as a leading economic indicator, because there are so many people that are involved in watching the stocks, publishing research on the stocks. Stocks have a tendency to be 6 to 9 months ahead of the overall economy, and I've watched that, and I'd have to say it still holds pretty true. So that's what fools everybody. They wait until all the news is good, and then they turn around and want to get in the stock market. Well, the stock market historically will have already made up most, if not all, of the decline by that point in time. And that's one of the reasons that Dalbar does that study on individual investors and how poorly they do. And I know why why it's like that is because you look for the news to turn positive. And by the way, I'm not sure the news is ever going to turn positive again. That doesn't sell ads.
Right.
And so all we see is negative stuff, and it's a trip. But I think that in the future, just paying attention is so much. It's not as useful if you understand what you're doing, like that mid-cap growth fund I was just talking about a little bit earlier. Okay, I know exactly which pool of stocks they're selecting those stocks from. I know exactly what criteria they're looking for in those stocks, profitability being one of them, which makes perfect sense, right? I mean, in the long run, you want stocks that are profitable. Why would you want stocks that are losing money? Now, that'll by the way, stocks that are losing money, oftentimes when there are new issues, they go up a lot on the expectation that they're going to make a lot of money someday. Okay. Well, a lot of those stocks crash too, and a lot of them crash and never come back. So all other things being equal, I'd rather have a company that's already doing business, has sales, and actually has a profit, and ranks in the top 10% of all companies for profitability. That, to me, that just makes perfect sense. And one of these days they'll get one that's perfect, and I won't have to work anymore.
Yeah, Bill, I have one other quick question. I'm going to ask it to you, and then I'm going to have to listen to you over the radio.
Okay, that sounds good.
What do you think, and I'm a gambler. Hi, how are you? Okay, I'll be right with you. I'm thinking about borrowing some money in the equity line of credit.
Okay.
And buying from a particular bank and buying their stock. Yeah, I know. All right, hang on to that stuff. Just hang on. I'll be right back.
This is hilarious.
I'm sorry.
This show's going to show up on somebody's YouTube video.
Borrowing on an equity line of credit, some money, buying that same bank stock back, and collecting their dividend.
Yes.
Now, the difference between the dividend and the interest that I'm going to pay on the loan
right.
is about 4 or 5% in my favor.
Right.
What do you think about that?
Well, there's this thing they used to call the risk-reward pyramid. Okay, so the bottom were things like U.S. Treasuries, CDs. The top would be options on futures contracts because those are the most aggressive. And what you're thinking about doing is actually a cloud passing over the top of that pyramid. The amount of risk that you're taking there is enormous. And it's a risk. So I probably, if you do it with any money at all, just do it with money and go into it. And this is what I've done that stuff in the past. And I always went into it saying, okay, well, I'm just going to kiss this money goodbye now so I don't get my feelings hurt later if it happens. And that's what I did. And most of the time, I'm telling you, most of the time it didn't work out. And occasionally it would work out. But I would hate to be doing that with a substantial amount of money. I just wouldn't do it. If it's more than 1% of your net worth, pass it up. Just not a smart thing to do.
Okay, I appreciate that. I'll let you know how it works.
Okay.
And I got to work at my 1% of my net worth. Okay, thank you, sir.
All right, thanks.
Enjoy the program. Keep it up.
Thank you. Bye. Yep, and if you have a phone call, number is 216-901-0945, 216-901-0945. And, we were talking a little bit earlier about the economy and that it's a big deal. And that's the one thing I really don't understand. I mean, I've been out of school for 30 years. Yeah, 30 years, over 30 years. And they taught this kind of stuff way back then. We didn't even have laptops. We didn't have an iPad. There was no internet. And they taught this stuff, and you could go look it up. And actually, Cleveland Public Library downtown was a great resource. And in Parma had great resources at their library. So you could go look this stuff up, and that's basically what I used to do because I was always interested in it. I got out of school, and I started working in this field. And those resources were really inexpensive, and they were really good. There's a company called Value Line publishes information. They had a lot more services than they do today, actually. And so you could get access to this information. But I understand that it was kind of difficult because you had to get out and go to the library, and or you could subscribe to these services that were unbelievably expensive, especially in those days. But today, most of this stuff is online somewhere, like the Bureau of Labor Statistics. Yeah, it's got a lot of statistics there, and that is actually one of the problems. Finding what you're looking for is going to take you probably a couple hours, minimally, a few hours if you're new to it. And a lot of people just don't really have that kind of time. So that's one of the reasons I still do this show. I know people don't have that kind of time. I know they're not going to take that kind of time. But I've got is that a phone call? Okay, I got to take a quick phone call right now. This is, actually, I don't know who this is, but you're talking to me. This is Bill Bullington.
Hey, Bill, it's Rich. How are you?
Oh, good. How are you doing?
I'm doing fine. You know who this is.
Oh, it didn't flash up on my board.
That's okay. I have a few questions for you.
Sure.
And the first one is last we spoke, we talked about the CD ladders.
Mm-hmm.
Have you been watching the rates?
Oh yeah. I've been buying them, as people request them. But yeah, they're pretty good.
Have they reached 4% yet?
Some of them have, but it depends. By the way, that stuff changes like on a daily basis, and so you have to keep up with it really on a daily basis. And I'm glad you brought this up because I wanted to kind of address this. Whenever you go in and you buy CDs or treasuries, you buy bonds in general, the prices on bonds move up or down. So you want to pay attention to what you're paying for it and understand that $1,000 is considered par. That's what the bonds typically mature at. They're going to mature at $1,000. So if you pay more than $1,000 for it, you're not going to get that premium back. That's called a premium. If you buy it at a discount, let's say you bought a $1,000 bond for $980. Okay, well, it's going to mature at $1,000, so you're going to take that $20 and add it to your return, and to get the total return, and then you add the coupon is the original interest rate that was on the bond when it was first issued. Okay,
so do these principles apply to CDs also?
If the CDs are traded, like on a secondary market, I know that we do that a lot. Yes. So sometimes a CD they trade just like bonds. It's not as frequent, and the spreads aren't very big, but they are there. So you have to be, you got to be careful on that. In fact, I think I remember back to the Series 7. That's an exam all people that want to be financial advisors for major firms have to take. It is a bear, and I think half of the exam is on bonds.
Okay.
Yeah. So.
All right. So now let's talk about electric cars for a moment. And just as an aside, I understand that for each windmill you have, it takes 700 gallons of oil a year to lubricate it. So figure that one out.
Well, I don't.
How many gallons of oil?
Yeah.
Do you use in your car a year?
Yeah. I know there are a lot of things, but you hear so much about a lot of that stuff that I would really, if I were going to fact check that, I'm going to look at least 3 or 4 sources to try to see whether that's true or not. And and that's everything. I mean, everything.
You bet.
Yeah.
So you look on the history of Spain and their air-driven electrical supply. And it's not very pretty. Okay, so now charging stations. Are there any companies that have been awarded the contracts for those? And who's awarding the contracts?
It depends. If you own property, commercial real estate, you can actually. It depends on your rights too. But a lot of building owners are basically leasing those things out. So you really have to call. And in fact, I have an acquaintance who sells charging stations for a living. And so he'll go. When he first started, it was actually several years ago. He was going to mostly like parks and recreation. People could, cities would approve of these things, and they would put them in. And now he's going to commercial sites, and they're going all over the place. So that's a thing of the future. It's actually a big part of it is growth. Nobody knows where this is actually headed, by the way, and that's what frustrates the average individual investor. There's so much stuff that you cannot possibly know. You can't know the answer. That's like knowing how many points the Browns are going to score in the fourth quarter of their third game next year.
Well, that's 0. So,
are you willing to bet your life savings on that?
No, but
me either.
So who are the companies manufacturing these?
Oh, there's a ton of them out there. Yeah.
Okay, so it would seem to me like over the next 10 or 20 years, that area would be booming.
It's booming now. They're trying to get it out there, and there's competition. I mean, competition from hydrogen fuel cell cars. That's so that's going to be all right. I think I got I just got the signal. I got to take a quick commercial break, and but you can hang on if you'd like to.
No, that's all right. I'll just talk to you later.
Okay. Thanks for calling. This is Bill Bullington right here on 1420. Stay tuned because I will be right back.
My first ride-along was with Jamal, even before I was hired. They wanted me to see everything from the ground level before moving forward, and it was awesome. The first time I came in, I got to sit in on a meeting and never realized that plumbers have that level of organization and sophistication to their operations. And I say that as a former degreed project manager as well as an Air Force vet. After getting out of the service, my wife and I moved to Cleveland, and I just wasn't happy with the corporate-style desk jobs. So I prayed for a sign. That next morning, my best friend called me about this radio ad on the Fish for a company he thought would be perfect for me. And he was right. Wyatt Works was a godsend. You have to want to help people. But if you do, this job is fulfilling in ways that the right person won't find anywhere else. If you want that for your life, call us direct and
consider it done at WyattWorks.com.
License number 30185.
Wallacadoodle. No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh, my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com. Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit JoyceFactoryDirect.com.
And we're back. Excuse me. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can go to my website, bullingtoncapital.com, to reach out to me if you'd like to have a conversation about investing, setting up retirement income plans, accumulating enough to be able to retire, kind of what we focus on, trying to build up enough in assets to be able to retire comfortably, whatever that means for you. And then once you're there, setting up those plans, putting them in place, monitoring, making adjustments. That's basically, I just described almost everything we do. And it's all centered around planning and investing. And the planning portion of it is for me, it's I've been doing it for so long, it's not that hard to do. But oftentimes I know people that are new to it or just approaching a retirement and haven't had a ton of conversations about it. A lot of it can be pretty overwhelming, but try to keep it as simple as humanly possible. In fact, I keep threatening to write a book on that, and then when I write it, it's not enough for a book. But I got to take a real quick phone call now. And again, if you'd like to call us, number is 216-901-0945. And Tom, you're on the Bullington Capital Report.
Hey, how are you doing today?
Pretty good.
Oh. All right, I inherited some money recently, and I don't know where to put it. The stock market seems to be losing. The Dow keeps going down.
Mm-hmm.
What do you do with a chunk of money right now? And then I read all these things on Yahoo that come through every day. Find all these different Manhunt Financial or whatever. Put your money into Bitcoin, or the next one, put your money into precious metal, and the next one, every day there's a different one.
Yeah, I know. I feel bad for
they think gold is going to go down, and then they're saying gold is going to go up. Then I go home and watch TV, and then they're saying how you want to start buying gold, and the next day you want to sell your gold.
Yeah.
What do you do?
How old are you?
Rose, 56 years old.
Okay. There's a bunch of other. Pardon me?
I have the 401. I have all that stuff.
Okay.
But this chunk of money is in separate from that.
Right. So basically, this is what we would normally do, and you're welcome to call in. There's a little survey. We ask some questions about your background as far as investing goes, and what your goal.
Limited.
Okay. Yeah.
Very limited.
All right. So that would be important if when you're gonna think you might need the money to use the money, what you're gonna use the money for. There's a lot to think about there. And
in a situation where no one needs to use the money, they don't need it. It's a bonus, and it's a good chunk of money, a couple $100,000, to just throw into something big, the next big thing. They're saying that in these markets, everything's at the bottom. Now the sky's the limit, or is it? But
yeah, I don't know. Nobody actually knows that. Somebody that's telling you that doesn't know either. And they've got something to sell typically, but in the long run.
And you talk about Bitcoin as being, you wouldn't put your money in any type of Bitcoin.
No, I just wouldn't do it. It's very, very aggressive. Okay, and it's only price driven.
Yeah, but those are the big gains too. They were down when you bought them cheap, and now they're 18,000.
Yeah, but that's like betting on the Browns. I'm telling you, it's the same thing.
100,000.
It's the same thing as betting on the Browns. I mean,
what do you think is the next big thing?
The next big thing? The next big things they're already here. The ones that are providing the new services that we need. We're using electricity. The demand for electricity is outpacing the growth rate in the population. So anything that's related to that, generation, equipment. Yeah. They've got a long way to go. And if, based on what you're telling me, I don't know how to put it nicely, but you really need you need to start reading a lot if you're going to start handling your own monies.
Yeah.
In the long run, stock prices have a tendency to follow the growth in sales. Okay.
Yeah, I know.
In the really long run.
If there's any big horse that's going to jump out front right now and really go. Also, years ago we were hearing about like all this energy crisis, but there was a guy that used to come on TV years ago, about 10 years ago, about talking to Pickett is his last name, or something with a P, and he was a billionaire, and he said natural gas is the way to go for the future. And I saw those buses running on natural gas, no emission control problems, no nothing. And buses around every city in America. And no one talks about the natural gas buses anymore, or natural gas transportation. They went to that electric movement to the government, world government. But
there's a natural gas.
Middleman.
Yeah, there's a natural gas.
That's a middleman, don't you?
Yeah.
When you talk about this whole electric vehicle exchange, it's just a big group of the deep state becoming a middleman again, because you're still burning coal to get the electricity.
Yeah.
It's just another filter in the dismay that we're going to see as our future goes. Yep. If you were talking a new energy that's going to replace something, that's different. Like a natural gas could replace all that and be clean emissions. They don't want to talk about that. They're bringing in the one that will hurt our economy and won't make a change, because every time you go to fill up with electricity in your car, a Tesla car.
Hey Tom, I'm going to actually have to let you go here, because I'm running out of time. But I would offer there's a free consultation if you want to call my office and set up an appointment. There's no problem. So
and we should have. Why don't we have the cars that drive on that charge your batteries as you go? They never brought that out either.
We do have those, and I can show you if you want to call me. I'll show you some websites where you can locate them. They're still not that popular, by the way. But anyway, I got to run because I still have other stuff I got to cover. But I appreciate your call, and feel free to reach out anytime you'd like.
Great show, great humor.
Oh, thank you. Okay, I had to go because I'm getting close to the end of the show. And if you have questions like that, just give me a call. I have no problem trying to answer questions for you. I can point you to different websites that have more information. So it's interesting. That's everybody's got an opinion, And I just like to try to get as much information as I can before I start forming mine. And there's a lot. I mean, it's a lot. In fact, he was talking about natural gas. Well, natural gas is down about 45% from where it was in 2014, and it was down 84% in 2020. So from 2020, if you go from the low, it's up 247%. And people go, oh, that's great. Yeah, but it's still down 46%. It was a whole lot higher in 2014, 2015 than it is today. So the bottom line is, and I'm not a big fan. We'll have to talk about that at another date. One of the things I am a big fan of are, and I never thought I'd be using these, but here's the deal. With a fixed index annuity, you get a guaranteed interest rate. Okay? It's only as good as the underlying company that's promoting it, so you got to make sure you do the best you can at picking very solid insurance companies for this. They give an income, and the income's still a lot higher than the CD rates, even though CD rates have gone up fairly substantially over the past, even just last couple weeks. So that may happen a little bit more, but you're getting a rate, and it's an income. That's basically what you're buying. You're buying an income, and it's going to be guaranteed by the insurance company, and they will pay that out for the rest of your life as long as you live. Now, there are tons of bells and whistles on these things. I mean, there's so many different types. You really need to know what it is that you're looking for, and it's an incredibly complicated endeavor. So if you'd like more information on that, if you'd just like a quick quote, hey, I'm 68 years old, I've got X amount of dollars, how much could I get in lifetime income for that? That's fine. That takes me 5 minutes. Or actually, it doesn't even take 5 minutes. It's less than 2 minutes. But we can do that kind of stuff for you. If you're looking for something different, there are thousands and thousands of products designed for different scenarios that you might come up against. One of them is nursing home insurance. That's a big one. Not insurance, but nursing homes. We'll talk about that on a future show. But the bottom line is there's a ton of stuff out there, and the advice that we give is for free. If you want to call and make a phone appointment, feel free. I'm willing to spend a little bit of time looking stuff up. If it's not directly dealing with investments or things like annuities, that kind of stuff, then I can refer you to somebody that you might be able to talk to, because realistically, you need a lawyer. You need somebody if you're going to do an estate plan. If your estate is big enough, then you definitely need a lawyer. Most people today, by the way, need a lawyer. And you're going to need a CPA or somebody who does taxes, a tax preparer. Those are the two of the most important people. A good financial advisor can save you a lot of money and help point out opportunities that show up in markets over time. And for most of our clients, we actually just manage the money. And I'm doing the same thing in my accounts that I'm doing in my clients' accounts. Different percentages. I'm a lot more heavily invested in stocks than most of my clients are, because A, I understand it real well. B, I'm not going to need the money for at least 10 years. And those are the A and B's. So I don't really have to worry too much about that. The biggest difference between my portfolio and a lot of my clients' portfolios is they have a whole lot more money in short-term bonds, because they don't want to be taking the same they don't want to put up with the same kind of volatility that I put up with. And now that I'm getting a little older, I'm to the point where I'm like, you know what? I'm not sure I like putting up with the volatility that I'm putting up with, but no, I'm good with it. I think that this is just another correction. I think there are a lot of things that are really negative that are going on in the entire world. But I mean, think about this. Remember the Vietnam War? Anybody? And if you're a millennial, you probably weren't around during that time period. Probably weren't born. But if you were around like me, you remember those time periods. And that was really rough. The stock market was really volatile for a long time, but eventually it took off. So I hear the music.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.